All right, good evening. This is a bit of a late one, admittedly. I don't normally go live this late, but let's cover a topic which we'll find the truth about in a few weeks' time. But it is a headline anyway. I thought I'd share this with you and just go through how this would technically work, maybe some considerations for people who may be impacted by this. So this is in the Telegraph today. Let me just bring this up. Rachel Reeves is considering a cut to the tax-free cash pension withdrawal. So this is the allowance they're referring to. So if you're not aware at the moment, when you start to build up your pension and you reach the age of 55, something called your pension commensurate lump sum or your tax-free cash becomes available. And that's essentially where you take the total amount that you have in your pension and you can take 25% of it tax-free. Now, you can do that as a lump sum, or you can do that in intervals, or you could take it as an income and still have it all be tax-free. It's something that people actually use to manage their tax position when they start to take income. And some people use that lump sum for other things, paying down debt, clearing off their mortgage, that kind of thing. Now, at the moment, the limit for this is 268,275. That's the current cap on it. Now, to get 268,000 pounds in tax-free cash, you have over £1 million in a pension pot. So what they are thinking of doing, or what is being advocated or thought through from a think tank, including the IFS, is to cap it at £100,000. And that will essentially raise about 2 billion quid in revenue for the government. Now, from a planning point of view, this may be a good thing, because what tends to happen is this, and I'm just going to switch over how I'm sharing my screens at the moment, just so I can kind of demonstrate and talk you through how this would tend to work from a planning point of view as a financial advisor. Bear me 1 second. Let me just make sure I get this right. I don't want to get this wrong. We're looking at this one here. Okay. So, and let's move on to, let's do this look. So typically, because people would take their tax-free cash, if you really think about it, and one of the issues that we have at the moment is that people aren't necessarily saving enough into their pensions. So let's just say you have a £200,000 pension pot, and that's the entirety of your pension accumulation during your working life. Then under the 25% rule, at this point in time, you can take 50k completely tax-free. Now, from a planning point of view, what that would mean is that you now only have £150,000 to derive an income from. And for many people, that means that they're seeing a significant reduction in the amount they can generate from their income, add on state pension, which may or may not be enough and may or may not meet your needs. But taking the tax-free cash sometimes can be a little bit of a detriment to people in terms of the income they're able to take. And even, when I was advising back in the day, when we were having these conversations with customers, with clients, we would always have to try and almost justify what they're taking this for, because we were always mindful that we had to try and put together an income stream from the remainder that may or may not meet their needs. But ultimately, it is the client's ultimate decision. So at the moment, if this does come in, and we don't know whether it is going to come in just yet, this is still speculation at the moment. We've heard a lot about pension changes coming along. If this does come in, what it could potentially have as a negative impact is people who are planning to do this, but in opposed to taking it as a tax-free lump sum up front to either clear the mortgage or clear a debt, if people want to use this 50k as a stream of income, and this income may fund someone for 2 years, it may fund someone for 1 year, if they're going to reduce the ability for you to take your tax-free cash and cap it at £100,000, then obviously that's going to have a bit of a negative impact. In the case of £200,000, it's not really going to have that much of an impact, because your tax-free cash is only £50,000 in this equation. But if you look at the chart, and maybe I'll link this article right here, £400,000 accumulated in the pension pot is going to get you the £100,000. So essentially, if you're over that limit at this point in time, so for example, right now, if you had a £500,000 in the pension pot, you get £125,000 completely tax free. You think about how long that might actually fund you in retirement. It could fund you for quite some time if you chose to take it as an income every single year, tax free. Now you're going to get to the position where having the cap is £400,000, like £400,000 in a pension pot. That's going to be your cap in terms of your tax-free cash allowance. Are people going to start looking at other vehicles to be able to draw an income from? And this is perhaps where maybe ISAs come in a little bit. But, I think my biggest fear is this. My biggest fear is that these types of things, if they do come in, if anything, they're likely to disincentivize people from actually accumulating quite a lot in a pension. And we know that people aren't saving anywhere near as much into a pension as it currently is. But I was on a coaching call with someone earlier this afternoon, and even in our conversation, we were looking at a £300,000 pension pot, and based on her income, it is something that she could do with the time that she has left. My fear is that if for people who are planning ahead and thinking about this ahead of time, if this is something that puts you off, does it disincentivize you and be like, actually, I'm not going to bother with pensions? And this is where people will ask the question, well, why would you not then put things into ISAs? Because that effectively is tax-free income. Well, £60,000 is the max you can put into a pension, obviously, depending on your earnings. £20,000 is the max you can put into an ISA. And I kind of said this to the person that I was coaching today. It's not a question of which one. It can be either or, but sometimes the pension has more weight because of the larger amounts you can put in, particularly if you're earning at higher rates. Will she do this? I don't know. I really don't know. I would hope that these type of things would be left alone, because the government is fully aware that the fact that we have too many people reliant on the state pension. The whole point of auto enrollment was to get people to take control of their own retirement savings, invest via their workplaces, and so on and so forth. This feels like a bit of a deterrent from that, if that makes any sense. And it's just a really, really weird one. I got invited to number 11, like just the day before the general election was called. And I remember there was a question to Jeremy Hunt, and he said that exact thing that I've just said to you there. We want people to be able to take control of their retirement planning. So if this is bought in, I know it's going to raise £2 billion, but does it do more damage and cause more problems later on because you've disincentivized people from putting into a pension? That then increases the reliance on the state pension, what was the objective of that you wanted to get away from anyway. You wanted to get people away from that. I really don't know. At this point in time, it's still kind of all very, very much speculation. A friend of mine was saying the other day that, the hope is that ultimately all of this stuff that we've been hearing about over the past month or so, that they're going to do this, they're going to do that, that hopefully it's kind of a smoke and mirrors, that they'll announce all of these things and the budget won't actually be that bad. That's what I'm hoping will be the case. But maybe at this stage it's wishful thinking. I don't know. We'll have to wait and see. But look, I don't necessarily like this. I get the angle that by doing so, you're kind of preventing the wealthy from taking advantage of the system. Like you need $1 million plus to get 268, to get that £250,000 limit. So yeah, it does benefit the wealthy up there. But for those people who are kind of like in the middle echelon, it will impact people who are in that bracket, and it will impact what you do when it comes to how you're going to draw income. And so if that is you watching this, you need to get some help in terms of planning how you're going to take your income if this does happen and it affects you. If you have £500,000 in a pension pot and that was going to be your strategy, you need to take some advice ultimately. So look, there we are. That is really what I wanted to talk about this evening. Really, really short, really, really brief. But yeah, guys, thank you so much for watching. If you have any questions, pop them down in the comments down below. I'm just looking at the comments of live right here. Someone just saying here, punishing the people who have done the right thing. We'll see a huge drop in pension contributions. That's my fear. Hopefully this doesn't come in. Fingers crossed. But that is what we know right now. And that's a brief explanation of maybe some things for you to consider. Enjoy your evening, because I know it's 9 o'clock. Thanks for watching. Cheers.